Welcome, everybody. We'll wait a couple of seconds here to get people in, and then pleased to welcome everybody to a new session of eState Academy and our webinars. We're kicking off a new uh, a new event. We're kicking off a new community, and I'm going to turn things over to Ian. You can see on your screen right now, um, and I'm just going to make sure Ian can unmute. But hey, Ian,
Hey, Jordy, sorry.
no problem. Um, just wanted to introduce you, Ian, and I know that you wanted to talk about the eState community that we just launched a few days ago, and welcome everybody. So over to you.
Sure. Just really excited about it. I know you and I are going to be monitoring it and using it as a resource for ourselves and for everyone in the eState community. I think we got over 260 people already signed up. It's going to be great. We're going to have our resources. The eState users will have resources. Any users who want to join up can have resources, and it's a great community opportunity. And one of those things that I know you and I have struggled with, and that is that, real time or relatively real time interaction, mentoring. Sometimes it's not so easy to track down the answer. Can't walk down the hall in the moment. So I'm really looking forward to working it and really I just an innovative step forward for I think all lawyers who are doing estate work. So looking forward
Yeah.
to it.
Yeah, and the eState community, it's free for everybody. Anybody can join who's an estate professional, whether you're a lawyer, a financial advisor, an accountant, a life insurance advisor. You can join. It's free. And we have general discussion groups. We have a big thing that we're going to do today after the main webinar with Marissa is have a Q&A on the eState community portal, a live Q&A. So if you're interested in joining and getting on that live Q&A, and you haven't registered for the eState community yet, if you look in the chat, there's a place you just click on it, link, sign up, and we'll get you live for our post webinar Q&A. So great place for example, there's there's places to ask questions and get responses. I just posted, I had somebody looking for a lawyer in Etobicoke who could do a house visit. I posted that, and in the eState Connect section. So, it's a great way to get referrals and to ask advice and all of those things. So, looking forward to people joining and join your colleagues and hoping it makes us all better. That's the idea. So. Anything, Ian, anything else before we turn it over? I think you're muted. I believe you're muted, Ian.
Judy wouldn't let me unmute. I was
Oh,
being
sorry.
controlled by
I
you
know, I
as
think I
usual.
locked everybody.
I know that's great. This is the way you keep me quiet. Yeah. Anyway, I mean, I really think it's an important resource that and then let's use it for mentoring and to throw ideas around the table on tough questions because that's the stuff that makes us all better.
Great. Well, thanks, Ian. And I know you're at a retreat right now, so I'm going to let you go. And I'm going to introduce our very special guest today. And we're talking about an area that I know very little about, and I try not to know too much about, or it'll scare me. And I'm going to welcome our guest speaker. And so we have Marissa. Are you there? Just
Yes, I'm here. Can you hear me?
okay. There you are. Welcome.
Thank you.
Welcome to the eState Academy. Marissa Verskin is a tax partner at Crowe Soberman. She's been doing this for close to 20 years. She advises executors and testators on tax issues relating to estates and succession, all of those things. And she has a master's of taxation. So that's very impressive. I got dressed up for you. I don't normally wear a jacket.
Thank
It
you. I'm
wasn't,
flattered.
yeah, it wasn't for Ian. I can tell you that right now. So what we're going to do now is we're going to go through some basic income tax issues, but mostly concentrate on the biggest tax deferral that exists, the most common one anyway, and that's the spousal rollover. And so our agenda today is we're going to just talk about how income tax works on death, and then look at spousal rollovers, both absolute gifts and qualifying spousal trusts. So Marissa, over to you.
Thanks, and thank you so much for having me. I'm really excited to be here, and I love the jacket.
Thanks.
So getting into the fundamentals of how tax works on death. The biggest thing is that death triggers a deemed disposition. So it's as if you sold everything that you owned for fair market value. So to the extent that the fair market value has increased during the time that you held that asset, this could mean that there is a significant capital gain. And what's important to note is that the tax is due even though the asset wasn't really sold. So that could mean that you have a tax bill, but you don't actually have any cash to pay that. The current inclusion rate is 50%, so capital gains are taxed at 50%. And then it's the same, the deceased has a personal tax return just like they do every year. And the income is taxed at graduated rates, meaning the first little bit is taxed at a certain amount, the next little bit at a higher amount, and on until you get to the top marginal rate. There are some things that don't, you can go to the next slide.
Sure, sure.
Not everything is going to trigger tax. So for example, cash. I don't really even report cash in a terminal return just because it really is a nothing. And something that just hasn't appreciated. If something hasn't appreciated, I would still report it, but pretty much other than cash, just for completeness. And then there are certain assets that don't attract tax on taxation, or they get reported, but they don't necessarily come with a tax bill. And a couple of examples up there are the principal residence and life insurance. So life insurance generally goes to the beneficiary on a tax-free basis. Principal residence, probably beyond the scope of this presentation, but in general terms, you can select one residence and effectively not pay tax on that one. But election forms have to be filed, and everything has to be done on a timely basis.
And Marissa, the way because I don't do tax returns. In the old days, lawyers used to prepare estate tax returns for their clients. I don't know if many do that anymore, but it's really an asset by asset issue, right? I mean, that's what we're talking about. An asset's deemed sold, the capital gain on that asset is included, or 50% is included. And when I'm ballparking numbers, I usually use, if there's a capital gain of $100, I'm going to use 25% of that as being assuming the highest marginal rate, 25% of that is the actual amount of tax on that asset. I don't know if that's right, or at least it gives a rule of thumb. What do you think about that?
So that makes sense. I'd use a slightly higher rate because it depends which province you're in, but in Ontario, the top rate is 53.53. So about half is, call it 27%. I'd rather be over than under on an estimate. But yes, I would pull all of the assets and then as a starting point, and then look at things that won't actually be attracting tax on death with the one example given of something like a life insurance. Did you want to talk about this?
Well, this is just how, if I'm trying to, whether you use software or you don't use software, when you're kind of thinking through it or having a client think through it, you take the capital gain, basically what I do when I'm just roughing these out, because these numbers are never going to be accurate from our planning point of view. They'll be accurate on death for sure, but when you're planning these things out, I usually just sort of ballpark a 25% of the gain kind of number and go through it that way. So just to give the client some idea of what we're talking about anyway.
And I like the chart that you've pulled out. You were showing me before this call, the software that you have. And I think it was really exciting to me the way you could map things out and see how things could fit into the different buckets. So that was really interesting to me to see.
Well, thanks. I didn't pay anything to get that.
No, I was genuinely really excited. It's really cool.
Thanks. So let's talk about these special assets.
So they're different assets. Again, they get different types of taxation. When you have a registered plan, those generally come into the deceased's income, full basis when they die. So regardless of what was earned within your RRSP or your RIF, whether it was a capital gain or dividends, doesn't matter. Every dollar that comes out gets taxed, taxed at 100. That full dollar is subject to taxation. And there are exceptions to these. So for example, if you have an RRSP or a RIF, and you are that RRSP is going to a spouse, that ends up not coming into income. And there are different ways practically of having that RRSP or that RIF be transferred, whether it's a successor annuitant or whether it's going to come in and roll. But in either event, there's no tax bill on the first spouse's death. There would be a tax bill on the second. And that segues into what is our next topic, which is really the most common deferral. And that is where you leave assets to a spouse. On the first spouse's death, you report the disposition of the asset, but it goes at cost base, not at fair market value. So let's say you had purchased a security. Let's say you bought, I don't know, Google, and it was at or IBM, and it was at $100, and now it's worth 120, and the first spouse dies. You would report the disposition of the share at $100, and then the spouse would pick up the share as if they had themselves purchased it for $100. And that means that if the spouse then sells that asset for 120, they pick up the tax bill on the $20. If they die, they are deemed to dispose of that asset at the fair value. Let's assume it's again 120, and the tax is then due at that time. Now, if that spouse remarries and has a spouse, then it could roll to that subsequent spouse. So if you keep the marriage chain going, you could defer for a very long time.
Now that's estate planning, right?
So that's, I mean, that is one way of deferring tax, but it's a deferral. It's not an absolute, it's not a never plan. Eventually somebody's going to have to pay the tax. One thing to consider there is that sometimes we don't actually want the deferral. And that could happen, for example, where there isn't that much value in the deceased's estate, and they're not using up their graduated marginal rates. And maybe the inheriting spouse is in a higher bracket. And you might say, you know what, maybe I have medical credits, or maybe there's some other reason that I want income in the return. And in that case, you can actually elect out of the spousal rollover. And that's on an asset by asset basis. So even if you have 100 shares of the same company, you could elect out only on a portion of them if you should so choose.
Would that be applicable if the spouse who just died had capital losses, for example? Is that when you would also use that?
Well, it's only if you want to, if you do or you don't want to trigger it. So if there's a reason that you don't want to, then you can elect out.
So we're going to talk about gifts, two ways to get this rollover, right? You can give it to the spouse with no strings, just what we call an absolute gift, and they get that asset and the deferral. And there's also the qualifying spousal trust, which I think we'll turn to in a moment. But this ties in with what you were just saying about, do we want the deferral on this, or there might be reasons not to, right?
Right. So the beginning point of any of these discussions is really, what are the objectives? So what does the testator wish to achieve? And in coming up with that, it's important to really understand what the numbers are. So what are the accrued gains on the assets? And that goes back to Jordy's initial slide, where he put out, there was artwork and there were all these different assets. Where are the accrued gains and where are the taxes going to be? And then it's a choose your own adventure. Do we want to roll to a spouse and pick assets that have a large accrued gain so that we defer tax as long as possible? Or do we want to make sure that the spouse actually isn't inheriting a large tax burden, because we want to make sure that if they're going to sell those assets, that they're not going to have the tax bite come out of their share, that they're going to have enough to live on. So it's really a holistic picture of exactly what they're getting and what they intend to do with those assets. So if it's a forever hold asset, having an inherent tax gain and a tax bill to pay down the road really isn't so important. But if they're going to be selling that asset, then suddenly that matters more.
Right. And when we're talking about planning for the spouse and others, maybe. You don't want the entire estate going to the spouse, for example, and you're trying to provide for your kids from another marriage or whatever. Understanding that if you're giving the spouse an asset that has accrued gains and they're going to sell it, it's not worth as much to them as it might look like, right?
Exactly.
One point I just wanted, I think you made this point that it's not an avoidance of tax. It's eventually it's a deferral. That's important. But the other thing is, and sometimes people think that if I make my assets joint with a kid, it's going to avoid income tax. It does not avoid income tax, right? When we're talking about non-spousal rollovers, sometimes people think that if I make it joint, it's going to automatically go to the child when I die and not pay income tax. It's a taxable event depending on who the other joint owner is.
And the other thing to note is that if you make an asset joint with the child, for example, you've disposed of half of that asset if you really have gifted it to them. So you're paying the tax at that point. Now, again, on that point, it's kind of interesting if you invest together with a child. So maybe you gift them cash up front and you invest together, because then when you pass, it's actually only your half that gets disposed of. So you've effectively deferred tax on the child's half. But certainly not the whole thing, and certainly not the portion that's yours.
So let's turn to the less simple approach to getting a spousal rollover, and that's the qualifying spousal trust.
So very generally, a qualifying spousal trust is set up so that the spouse has the income from the assets for their lifetime. They might be able to encroach on the capital, maybe yes, maybe no. But certainly no one else may touch any assets, neither income nor capital of the trust during the spouse's lifetime. And on death, the document would specify where the capital would go, whether that be to the children or wherever else it might go. When you have such a trust, when you do have a true qualifying spousal trust, that spousal rollover is available. Always with conditions, but the spousal rollover on death is available. And one important one is that the property has to vest within 36 months in that spouse. So if you have, for example, private company shares that are sitting in an estate, so somebody passes away, they owned private company shares, and those shares automatically go into the estate. And if they sit in the estate for, let's say, 5 years, that would not necessarily indicate that the shares have vested in that spouse, and therefore you might not have a rollover on death. You might actually have a taxable disposition on death. So it's really important to watch that 36-month period. It's possible.
What does that mean? Like on an admin point of view, I hear about vesting in 36 months, vesting in 36 months.
Right.
Obviously, if it's an absolute gift, that vesting would be less of an issue. But in the spousal trust, are we talking about actually transferring an asset, the shares in that private company that you said, into a different account, or what does it mean?
So when you have a spousal trust, it is separate from the estate. So the estate is really your vehicle. It's almost like a mixing pot. All of when somebody dies, everything goes into the estate. And then if there are other trusts, it basically gets funded from that pool, or if distributions are made to beneficiaries, it's funded from that pool. So and that applies to if it's marketable securities, the spousal trust would have its own separate investment accounts that would be set up. So to me, the easiest and cleanest is if it's marketable securities, you just transfer them from the estate account into the spousal trust within that 36-month period. And that shows that clearly they've moved. Otherwise, you can have legal documentation where it's, say, private company shares to show that they've moved. Vesting is really a legal question, and it is possible that a spouse's right has vested indefeasibly, notwithstanding that the asset is still within the estate. But that comes down to a legal question. And in my mind, the simpler and cleanest way is better. And so my preference would always be to really show that asset has in fact moved from the trust, and then it's much easier to prove that you must have satisfied the vesting requirement because you've moved the asset.
So those requirements, and the big one that we get in trouble with as lawyers when we get instructions from the testators, I want a spousal trust, but if my spouse remarries, stop the income. you know, or pay the income to my kids, or can my kids access some of that money? No, is the
Absolutely
answer.
not.
Not and get the rollover. You can't have it both ways. So, and if we have any e-state users out there, they know if you try to create a qualifying spousal trust and you do it wrong, e-state will warn you about that and tell you how to fix it. So let's just talk about some considerations about when we're thinking about using a QST, qualifying spousal trust.
Sure. So the one you mentioned is really important, that it really has to be absolutely for the spouse, and no other person can have any access to the income. And that requirement goes pretty far. So if you think about life insurance premiums as an example, the qualifying spousal trust cannot pay life insurance premiums on the spouse. And the reason is that the spouse is never going to see the value from those premiums. And so clearly by paying those premiums, you've allowed somebody else to benefit during the spouse's lifetime, and that can upset your qualification as a qualifying spousal trust. There's a similar sort of issue when I spoke about kind of this mixing pot of the person dies, the assets go into the estate. What if I have an asset that's earmarked for a qualifying spousal trust, but it kicks up some income? You theoretically have to be very careful with that income because it is only for the spouse. And you could theoretically upset your qualification as a qualifying spousal trust by paying out that income to someone else. And an exception is presumably the payment of taxes, because payment of taxes really trumps a lot of other things. Similarly, if they're assets of the trust and someone else wants to use them, it's okay for them to use them, but then they need to pay market value. So generally, if there's a fair market value transfer, then it's considered that the qualifying spousal trust has received value for that asset, and therefore you don't put it offside. There's a lot of complexity when we look at the idea of charitable gifting, and whether the gift comes from the estate or from the qualifying spousal trust. And I think the bottom line here is that if charitable gifting is a significant objective, you really need specific tailored advice to make sure that you're not losing out on any of the tax credits. I can give a couple of examples with charitable giving. If the estate gifts to a trust that's considered to be a charitable remainder trust, the estate would get the donation receipt and would be able to claim a tax credit upfront. With a charitable remainder trust, it could be a qualifying spousal trust as well, meaning a spouse has access to the income during their life, and when they die, the whole amount of the residue goes to the charity. So if that's the case, we have no leakage, but it also means spouse only gets income. They cannot access any of the capital. So we're taking away some of the flexibility there, but we are getting a good tax result.
And Marissa, that's a very unique planning tool where you do a charitable remainder trust. But what about the situation where you have a spousal trust and the client says, listen, I want to get rid of the tax when my spouse dies because it's a deferral and I know tax is going to get triggered on their death. Why don't I just put on a legacy for $250,000 to a charity? And now I'm going to avoid that tax. What's the issue with that?
That's a great question. So the problem with that is that may not be a gift. And again, it comes down to a legal question. But if the qualifying spousal trust is required to make this distribution to a charity, it's really like they made a distribution to any other beneficiary. There's no donative, there's no charitable intent there. And the giftor is really the estate, but the estate is not the entity that's making the gift. And so you could have leakage in that case where you are making this $200,000 gift, but there's no tax credit. A way that it seems you could get around that is if in the qualifying spousal trust, if there was discretion on the trustees where they could choose the amount of the gift, or they could and they could choose which charity the amount was going to, that would appear to indicate that there's donative intent. Again, it's a legal question, which is beyond my scope, but it would appear that that's how you would be able to get this donation credit. But then the testator is really giving up all of their control. They're saying, you can decide for me. They might leave a letter of wishes, but it would really be up to the trustees to decide whether or not they're actually going to honor those.
because the problem is the trust, the spousal trust is the one making the distribution to the
That's right.
charity at the end of it. But it has no choice. It's not a voluntary gift. The trust is told you have to make this gift. And what CRA, and I think it's a little bit of a crazy thing, but CRA is saying, well, that's not voluntary, therefore it's not a gift.
Right.
And if you use eState and you did this and you confronted this issue, eState would give you a warning about that. Because there is, you basically lose that charitable gift donation from the spousal trust. It doesn't get rid of the income tax on the second death unless you do it differently than just an absolute gift or a specific gift, right?
Right.
So that's a big one, really, often.
There might be other ways of structuring it. So maybe you have, if you have a very large estate, and we have a slide a little bit later on this where you segment it, and maybe you have a qualifying spousal trust for some assets and you have a different sort of trust for some of your other assets. And so you can sort of pick and choose and try to get to the best of both worlds. One of the risks of doing that, first of all, you're adding complexity. But you also might land up in a situation where you might have gains in one of your vehicles and losses somewhere else. And you can't commingle your assets because they're in two totally separate entities. And so there could be leakage there, and that might not be ideal.
I think the key is to be aware, at least for many of us who are watching you, and for me personally, I want to just know I got a problem here. It's not as simple as the client thinks it is. And I need to hire somebody like you or a tax advisor who can tell me what the real rules are, because we can get into trouble here when we try to combine charitable gifting and spousal trusts and other things. But in summary, because we only have a couple of minutes left, this is the most common rollover available, but there are traps, right?
Right.
Yeah. We're going to continue. This is a brand new thing that we have. So we're going to continue our discussion. I want to thank Marissa very, very much. She's going to be back with me in the coming weeks to talk about principal residence exemptions and trusts specifically. That's a whole other topic. We wanted to concentrate on the classic spousal rollover tax trick here today. But we're going to continue this talk right after at 1 o'clock on the eState Community Portal. Basically, if you join the portal and you go to events, you will see both Marissa and I on there, and we're going to continue questions and answers about some other topics relating to spousal rollovers. So please join us there if you're a member of the community. If you're not, there are instructions. You can join right now, and there are instructions in the chat, in the Zoom chat. And please join us. We'd love to see you there. And thanks again, Marissa, and thank you all for being here.
Thank you so much for having me, and see you in a moment in the eState community.
Great. Thanks.